Manav Chopra is joining us now, Director Technical Analyst at Nuvama Institutional Equities. And I can't think of a better day to have spoken with you, Manav, because you've put out a report focusing on small and medium sector, small and medium stocks, mid stocks, and they are the ones really taking it to the chin today. Let's start with the context, and before we get to the details of your report, let's start with setting the context of why we are seeing so much pain in the broader markets. What, in your view, are the key concerns and worries?
So what we've seen over the period of time when we're looking at the long-term scales, see the markets definitely we are in a larger bull market scenarios, but there comes a phase where the market reaches to one of its extremes, and it's unlikely that the market moves higher, and we haven't seen any major returns or the positive returns coming from that side. So starting from since July or mid-July, we've seen the breadth of the markets. We have seen a significant amount of decline in breadth since July, as the mid caps and the small caps continue to make new highs. The breadth started deteriorating, and one of our proprietary indicators of identifying the extremes of the market also reached 95 percentile in the month of September. So when the markets had witnessed a raging rally of 6 consecutive quarters without any breather, the breadth started deteriorating. We did witness some undercarpet correction already started to play in the month of July. And when all these parameters started to come in, and certain pockets already started to witness some bit of a decline, obviously with deteriorating breadth. These were some of the early alert signals which was witnessed in the month of September. But lately, the rally that we've witnessed from 7th of October in last couple of weeks, largely it was a very polarized rally in the mid and the small markets. And we have seen like a micro cap, Nifty micro cap index almost making new highs, but the mid and the small caps were significantly below its previous peak. And not only that, the broader market sentiment of Nifty 500 has violated the 50-day average. So these are some intermarket divergence which definitely indicate that the internal breadth of the segment is giving away. Largely, the rally was more like a polarized rally by a few heavyweights of the mid and the small cap. But these kind of indication is definitely not good, which we have highlighted, and it is more like a portfolio allocation that we recommended our clients to switch out and trim your mid and small caps, get into the classic low beta. But we anticipate the mid and small caps to decline by another 5-10% from the current levels. The small cap index has formed a bearish head and shoulder pattern on the daily charts. Usually such formation leads to an intermediate top, and any violation of important support levels, that leads to a short-term to medium-term bearish trend. So having said that, I think it's a good approach in such kind of an environment where one needs to take a setback and let the extended rallies in this market see some bit of a breather and correction going forward.
It's also Samina joining. It's another 5-10% to go on the mid cap and the small cap index. Who do you think is going to lead the way down further? Is it going to be high beta stocks? Because I did read your note where you say best time to hide is going to be low beta plays. So would you imagine that stock sectors such as auto will continue to decline further from these levels despite the recent weakness we've seen?
Okay, so the one of the segments of the mid and the small caps, which is quite heavyweight on names like the capital good names like your BSE, your MCX, your CDSL, they are still very much holding the fort, along with names like Glenmark, Persistent, Dixon. These are the names which have the maximum weightage and which have shown a good amount of resilience and holding the fort for the mid caps. My sense is that you might see some bit of a pullback coming in these names. The broader space have already started to give away, let it be the PSU Banks or names coming from other pockets of defense, or they have already declined. But my sense is that within autos, the auto anchors which have still maintained its support levels, they are still on verge of breaking down. So I think going forward, the next few weeks will be very painful, looking how the mid and the small caps are shaping out. Unlikely to say if something, you might see some bit of a respite or a trading bounce, but largely I think whenever we've seen such formation playing out, you see broader markets going and seeing profit booking all across. But since the autos, the frontline names have already declined, I think the auto anchors names have some bit of a room on the downside, including the tire stocks. So there will be pain in pockets, but we are strongly recommending that the low beta space, like your frontline private banks, your pharma names, your select IT names. This is the space where one should get navigated into the markets for next few months at least.
Sorry, Manav, good morning, Neeraj here. Did I hear you say that people should kind of find the hiding spaces in IT and pharma, or is it the other way around?
Yes, so obviously, I mean, hiding spaces in the frontline IT with frontline pharma names, private banks is where we would recommend to hide, at least in the low beta front. My sense is that even in select pockets of mid caps and small caps, let it be Persistent, Glenmark, your mid caps might witness some bit of a trim coming in, but we are very clearly advocating for next few months to be into the low beta defensive space over the high beta names.
Months, Manav. Did I hear you say a few months? And therefore, does it mean couple of months? Does it mean more?
Difficult to anticipate how the kind of a time phase correction could be, but logically, Neeraj, we've seen this formation play out in the past. We are aware the kind of fund flows or the domestic inflows we have. Basis on this, when we had a similar formation happen in the month of end of 21 November December 21, we witnessed a similar formation which got extended for a period of 4 to 6 months. And honestly, this seems to be a very healthy scenario if it plays out. So if you've seen a 6 months of rally, maybe 1 or 2 quarters of some bit of a pullback, under carpet correction, a correction of at least 10% to 15% from all-time highs would be quite logical on the larger time scale. But what we are anticipating is an intermediate kind of a correction, a lot of some bit of a shakeouts which could play out in the mid and the small caps. Largely, my sense is that the frontline names might not witness more decline. Maybe the Nifty might just take some bit of a breather or a pause at 24,000. But the mid and the small cap have reasonable room of price correction, but which could further lead into some bit of a time price consolidation eventually. There might be some bouts of trading rallies, but you might come into a scenario of making lower tops and lower lows, and we will wait for that cool off phase to get over before we turn bullish. But at the moment, I think we should let the market take its own course, see some bit of a decline coming in, and then we'll revisit if the scenario changes for us.
Manav, within the broader market space, and point taken that the frontline stocks might not see such a big hit. You might see a breather on the Nifty at 24,000. But within that space, is BFSI looking more vulnerable to you? I'm not just referring to what's happening to Manappuram Finance this morning. Okay, there's some news flow there. But NBFCs, your smaller public sector banks, which have run up a fair bit, are you seeing the pain point there?
See, the PSU Banks has already been correcting since last 4 months. We have seen that phase of correction which have already played out. You might see a bit of more knee-jerk coming in because of the market volatility. But my sense is in this market scenario, the NBFCs are usually the which witnesses more hit. Names like Piramal Enterprises, which have been consolidating, has started to dip lower. The L&T Finance, these are the pockets which could see some more pain coming in going forward. But the PSUs in general, I think the first phase of decline is almost over. You might see another dip, but not like a larger one at the moment. So within the financials, I think the way the Bank Nifty has declined, there might be certain pockets where you might see a little bit of pain, but largely I think it's only the private banks, including with insurance, which could be the savior for the space. But largely NBFCs might see some bit of an underperformance going forward. So I have a neutral bias in financials, not very bullish in general, but I would prefer private banks just for the near-term perspective.
Okay, let me talk a bit about your spaces like Zomato, looking tough today. And I don't know how much you want to go stock specific, but Manav, these are the companies that have really seen the big run up. So let's start by talking about Zomato. Let's start by talking about some in the defense space as well.
Fair. So I'll start with the defense in general. The public sector theme, which has been one of the most darling theme of last 2.5 years, which have seen a reasonable amount of decline. A lot of stocks are down by like what 20-30%. Some have already seen an overextended decline of 40% from the shipping space. My understanding is that at least the price decline is almost over there. You might see that sectoral churn coming in. The price decline is almost over. You might see a bouts of short covering in case if the market stabilizes in the short term, but there is a phase where the market bottoms out and then eventually consolidates, gets into a lull phase before it resumes on the uptrend. So I think you might see some bit of a no action price kind of a momentum for a while. The price pain is over in that scenario, but not major V-shaped recovery, which could take these sectors higher. But largely, I think the pain point is over. Now we need to focus where the pain point could eventually come up. I think that's where one should be a little more cautious about. Talking about the stocks like Zomato, I think this has been on a very good classical strong uptrend move. Any dip of maybe like a 10% from its recent highs has always been a good opportunity to enter for long positions. So there'll be certain pockets of stocks and sectors which will eventually do good because we are still in a larger bull market. It's just that the intermediate correction would give us some opportunities for long ideations, and I think Zomato as a name does qualify in that perspective. But when we speak, I think on the defensive fronts, yes, Zomato within the mid caps, along with some of the pharma names would be the space where you might see some bit of buying in general, despite of the market momentum, but we still would want to wait and watch and let the market take its course before we come high, because I think the mid caps and the small caps could see a dip of like 5-10%, but not on the immediate basis, but eventually going forward. So at the moment, we would want to wait and watch, but largely speaking, still fine with the Zomato at lower levels.
You're still fine with Zomato at lower levels. How are you feeling about a Polycab and a Havells, both with numbers out? So that's, of course, on the fundamental side, not great for this quarter. And all right, today in this kind of a trading day, both are getting hit. But otherwise, are you feeling like there's an up move there or further pain in store?
See, actually, whenever the price witnesses such kind of a dip on the news front, it's very unlikely that the price recovers, moves higher. But largely speaking, I think you will see some bit of consolidation or underperformance in these names. There might be a pullback of 4-5%. I wouldn't want to read too much into it basis on the result preview, but on the brief basis, both these charts have highlighted some important key support levels on the weekly. I'll let some assessment happen in a while, but there is a scenario where I don't see both these stocks at least move higher on the immediate basis or go to its previous high. So keeping that in mind, I think one can wait for a bit to look or review for any bullish stance into this space in general. But there will be certain pockets which will give you better offerings in times to come. So I think it will be more like a wait and watch approach for a near-term perspective.
Manav, what are you doing with auto companies? You mentioned that auto anchors, which have held up, will see some pressure in the next few weeks. But what happens to frontline auto counters as well? Bajaj Auto, Maruti, M&M, even auto financing companies I'll throw in there, like Shriram Finance. These counters have had it very difficult. Do you feel like this is now seeming like there could be a dead cat bounce, and hence on the charts they look like good buys for the short term?
Oh, okay. So auto as a space, has seen the first breakdown on its monthly chart. In fact, it started to happen just a few weeks back. We have witnessed also a trendline breakdown. And when the index in general starts breaking below the 100-day average after a good bull market with weak breadth of the sector itself, my sense is that at least for the near term, the intermediate top in the auto is done. You might see another 5-10% dip coming into this sector. because cyclically we have seen how, if the correction phase starts in the autos, it usually doesn't stop on immediate basis. It usually sees some more time and bound kind of a correction that plays out. I think the pain point in Maruti as a space could see some more downside in time to come. I think that's been one of the laggards in the last couple of months. We have already seen pain coming into Bajaj Auto, but name like Maruti might see some bit of more downside along with auto anchors and tire names in general. And on the medium term perspective, I think some bit of a cool off into the autos would be the time where you might want to look once the index dips by another 5-10% to reinitiate at lower levels for some bit of re-entry. But at the moment, there will be some bit of a more decline coming in for me. Auto index, if I'm not surprised, you might see decline all the way towards 21,500, 22,000. I think that's where you might see some long-term supports coming into this sector for the near term.